I call the Honourable David Parker.
Thank you, Mr Speaker. The Labor Party supports this bill. The Minister's quite right. The Minister who's just resumed his seat in saying that the Select Committee thought that it was important that provisional licences can be kept for a longer period of time than was originally envisaged. The reason being that if a company gains a provisional licence but can't convert it into a long-term non-provisional licence because, for example, of insolvency, then it's desirable that there still be a level of oversight by the Reserve Bank that can occur under a provisional licence that couldn't occur if the insurer was unlicensed. And so this helps the Reserve Bank and the government through the Reserve Bank to maintain oversight of insurers in that situation. Mr Speaker, there's an important outstanding issue in respect of the prudential supervision of insurance companies that is not touched upon by this bill, which is a difficult issue for New Zealand to grapple with. And I want to, before I sit down, just mention the complexities around that issue, and that is whether the prudential standard upon which insurance companies are judged is their ability to meet either a 500-year event or a 1 in 1,000-year event. And of course, if the requirement is for them to have a strong enough capital position to meet a 1 in 1,000-year event, that effectively means that they've got to have a stronger balance sheet. And at first blush, you can understand why the Reserve Bank might want companies to have a stronger balance sheet in order to meet a 1 in 1,000-year event. My understanding is that the Alpine Fault ruptures approximately every 800 years, and that will probably be the biggest insurance event that it's possible to contemplate in New Zealand. And that's one of the reasons why the Reserve Bank is looking at the Wellington one would probably go out in sympathy. You know what Wellington's like. Now, the consequences of that would be dire for New Zealand, but it's a different question, or that's not the only part of this question as to whether we should move to a 1 in 1,000-year prudential requirement rather than a 1 in 500-year, because there are some consequences of that. And this has been passed on to me by a number of participants in the insurance industry, and I don't believe that they're talking from a self-interested position. Indeed, I think that they have New Zealand's interests at heart in respect of this issue, because they can live with either eventuality. The first is that if there is a higher capital requirement required of an insurer, it may be that that capital is not available to them. The multinationals who are present in New Zealand compete for capital amongst different parts of the world, so it may well be that they just can't get the additional capital to put into their New Zealand operation, and that their parent company chooses, on balance, given our risks in respect of earthquakes and the like, to withdraw from the New Zealand market rather than to bring forward that additional capital to their New Zealand subsidiary. And that would mean that we have less competition in insurance in New Zealand, and we become more reliant on the remaining insurers, which in itself increases risk in the event of a very big earthquake. The second issue is that even if they could get that additional capital in New Zealand to meet a higher prudential ratio to cover 1 in 1,000-year event rather than 1 in 500-year event, the cost of that increased capital would be passed on to the people who buy insurance or buy premiums from those companies. In other words, people's insurance bills would go up. Now, if people's insurance bills go up, then some of those people who would otherwise have taken insurance will not take insurance, or will take lower levels of cover. So in terms of the effect on New Zealand's insurance cover, it could be, I'm not saying it would be, but this requires careful analysis, it could be that increasing the capital requirements could actually result in lower levels of insurance in New Zealand. So it could be counterproductive if what we're trying to do is minimise the risk of consequences in New Zealand if there's a really bad earthquake. If we've got fewer people insured against different sorts of risk, and it's not just their household cover or their contents cover, but things like business interruption insurance, all those other sorts of cover would be affected by these same capital ratios. And if insurance costs go up and levels of insurance drop, then we could actually have the opposite outcome to that which we intend, even though the Reserve Bank might be thinking that they are improving from their perspective the financial stability of the insurance companies. Overall, New Zealand might be worse off because we have lower levels of insurance. The third area where this is relevant is what is the effect on competition with the multinationals. Now, over the last 2 or 3 decades, we have seen a concentration of ownership by overseas multinationals of New Zealand's insurance market. This is also something that's happened in the other parts of the financial services sector, like the banking industry. And as a consequence of amongst other things, monetary policy setting and tax settings, New Zealand has been hollowed out when it comes to ownership of our own financial services sector. The ability of small New Zealand companies to start up and grow into companies that compete with these overseas companies, who of course repatriate profits as any insurance company would do in that situation, could be inhibited by increasing stringency of capital requirements, which make it harder for new entrants to enter into the market and compete. So, Mr. Speaker, none of those issues are dealt with in this Prudential Supervision Amendment Bill, but they are coming at us in respect of an issue as a consequence of the Reserve Bank saying that it is considering whether to increase the prudential requirements from 500 to 1,000 years. I, for one, will take some convincing that the issues that I have raised are not more important. Mr. Speaker, the Labour Party supports this bill.
I call the honourable member Paul Goldsmith.
Thank you, Mr. Speaker.
You're welcome.
My pleasure to read